ultra healthy part, it would be to see deals first exclusively and at a better valuation, and that'll compound your wealth very quickly.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. We've got another awesome show for you today. Today we're joined by Richard Wilson. Richard is a third-generation Eagle Scout, loves investing in fun adventures and health, and is a husband and father of 3 living in Scottsdale, Arizona. Richard owns Billionaires.com, where he is interviewing 100 billionaires, and he is the CEO and founder of the Family Office Club, with 4,000 registered ultra-wealthy families and 15 live events a year. His short-term rental property fund, InvestorResidences.com, has equity in 83 properties, and his division focused on investing in profitable medical practices has equity in 23 practices with over $45 million a year in revenue. Richard has also helped create and formalize well over 200 family offices for ultra-wealthy families, including Billionaires and a shark from Shark Tank. Over 16 years since starting his investor club, Richard has hosted 190 live events, spoken at over 600 live events, been interviewed over 300 times, recorded 3,000 plus videos, and has written 13 books. Richard has an undergraduate degree in business, an MBA, and has studied postmaster's psychology at Harvard. Richard, my friend, welcome to the show.
Thanks for having me here, Dave. Good to see you again.
Yeah, it's always such a pleasure, Richard. And, just reading through your bio, so much there, such a treasure trove of knowledge. I know that you can impart to the listeners, and they're really going to enjoy this show today. So why don't we, just kick things off a little bit and tell us a little bit more about your background and how did you get into this whole, family office space and building wealth alternatively? How did it all start for you?
Yeah, sure. So I actually grew up around my dad raising capital from investors for hospitals and nonprofits. He's raised over $1 billion for them. So I'd go to meetings where he would ask a donor to endow, a hospital wing or a university professorship or something like that. When I got out of college, I started raising capital. And while doing that, I found it very challenging to raise capital from high net worth individuals or normal wealth advisors because their clients weren't accredited investors. And so they'd say, no, we can't invest in your hedge fund product or whatever it was. And so I figured out the fastest way to raise capital for a hedge fund would be to focus on the wealth advisors who only serve the ultra wealthy, who are all accredited, and they were called multifamily offices. And when I heard that term, I said, well, I should just only be calling them and not wasting my time working with other types of wealth advisors. So when I tried to do that, I found there was no trail guide. There was virtually not even a single book on the industry to help me. And so I just started a blog and started writing about what I was learning. And I started getting 1,000, 3,000, 5,000 hits a day on the blog. And then we bought familyoffices.com and I got a book deal with Wiley and spoke several hundred times in, 20 or 30 countries over time as that built up. And it all just kind of evolved over the last 16 years into what is now the Family Office Club.
Yeah, that's really fantastic. And talk to us a little bit. I mean, what's been so great in, getting to know you over the past couple of years, through the club and just communications and even have the chance to meet your wife recently has been awesome. Talk to us a little bit about, your value system and how you kind of see, family office and values, because I know we really share the same ethos there as well.
Yeah, for sure. So while everybody seems to have values for their company, and it's very kind of common sense and boring to say, oh yeah, your company should have values. What's not common is to have values for your family and have those defined and have those, for example, above your kitchen table so that if you are going to make a critical decision, you're not sure, should we move to Hawaii? Should we move to Florida? Should we do this or that? You can make them based on your values. And, it doesn't cost anything, yet every family should have their family values spelled out. Even more so if you have kids, you're trying to bring up the right way, because you could lose your wealth, but if you have the right values, you'll make back your wealth and you'll protect the wealth, and you won't have the wealth sacrificed, while at the same time sacrificing relationships between family members. And so my 10-year-old has our family values memorized and can recite them, and she has on stage at several investment conferences where I've brought her. And I think that's really critical. And then I really feel like when it comes to values, that the value of health gets lost with a lot of my ultra wealthy clients. They oftentimes will spend $100,000 a year on plane tickets, even if they don't have a private jet. They'll have multiple homes. They'll spend $200,000 a year on their wealth advisor. But I've been in rooms with literally, it's filled with doctors. They can navigate the healthcare system, and they're spending, in this case, it was $30,000 to $50,000 a year on a wealth management club. And there were 130 of them in the room. And I said, who spent more than $30,000 last year on improving and maintaining their health? And one hand went up out of 138 people who work in the healthcare industry. And so what's interesting is that that's basically communicating that you value your money more than your own body and your own, health. And your body is required if you want to keep on making more money, right? And you'd rather be alive than slightly wealthier. But everyone has that backwards, and they're investing in a whole bunch of things, but not themselves and not their own health. So I always try to course correct clients on that as much as I can.
Yeah, I've always found it fascinating. And also, I did not realize that you actually have some training in psychology as well. And when I kind of, through my years and my journey around wealth building, part of it that really unfolded for me that became really holistic was this whole notion of like, what does really wealth mean to you anyway, right? And I like the term wealth rather than being rich, right? Because anyone can make a lot of money or buy an expensive car, right? But it's having wealth, right? And that means different things to different people, but having that kind of holistic look at that, I think is critical. And, as you say, talking about health, how much would Steve Jobs have paid, right, to be able to solve his health challenge, right, and still be around, and I look at like LeBron James literally spends over $1 million a year on his health, right? So, that's really fascinating as part of that. And also, not only the value of your health, but it's like how much that can actually drive you towards your goals and your vision, so much more. And I know you're really athletic and you're doing, even in your bio, that's really cool. You're talking about doing adventurous things in the family and everything. So how else has that really helped you in terms of, health and having kind of a holistic vision to wealth?
I move very quickly, and I feel like if I had bad health, I would not have the energy I have. I would not be able to keep up with all the exciting things going on. Every time now there's so much going on in our business, I have to fly, I don't have to, but like, I feel like I have to fly first class because I need to get 100 things done on every flight, and I can't be cramped like this or have someone's seat, make it so I can't really get work done. And I bring that up because when I'm flying first class, I guess everyone else is much more relaxed. And we have so many exciting things going on. I'm usually the only person working in first class. Everyone else is watching their Hulu or taking a nap, which is great. You need sleep to be healthy. That's the whole point of our message here. But I think that if you want to really excel, then you need to be high energy and have that ability to focus. And so that's one thing. The other thing is that I find that clients realize how misbalanced their life is, and they're just not sure how to course correct it or what actions to take. And so I'm doing 30 different experiments with myself. Like I did a full body MRI that took an hour, and I just paid for it out of pocket to look at over 300 different things that could be wrong with me, and then investigate the 1 or 2 or 3 things that they find to de-risk those. Because if you catch cancer early, then it could save your life. And so I'm only recommending to my clients things that I've spent money on and done myself and found them to be valuable, like getting biomarkers and identify 30 different things your body might be off on, like cortisol levels or different types of B vitamins, et cetera. And so that's one thing I've found has been really surprisingly useful for my clients. They often say that that's actually more important than me helping them with their investments. And they've been looking for help with that. And so right now, I'm just selfishly doing it for myself. But as we get deeper and deeper into that, it's going to be a core part of what we offer to our clients is like, hey, we can help you with setting up your family office or your direct investment strategy. And then within our company, we focus on profitable medical practices and short-term rental properties as our two investment platforms that we're growing. But I think the health part will be part of that core of like, you know, even if you have your family office set up, do you have like your health management set up for an ultra wealthy person? Because if you're worth $100,000, you can't spend $20,000 a year on your health. But if you're worth 20 million or 100 million, you should be spending at least 20,000 a year on your health, if not much more, right? So it's been surprising to me how popular that is. I bring it up to people, and almost everybody who's ultra wealthy leans forward and says, "Oh, I want that." Or, "Do you need investors for that?" And I'm like, "No, I'm not raising capital for it. It's just something I'm doing for myself." But over time,
Right.
we want to share it with others, you know.
Right. Well, that's so great. And what I find that's been so amazing for myself, because I have my markers checked as well. I have a functional doctor. But this study around health and human performance, mental and physical, it's really astonishing to me, and where technology is going, and following, folks like Peter Diamandis and some other folks in the realm of longevity and vitality, and where some of the technology is going. Some of my recent protocols have been pulsed electromagnetic frequency, so grounding, oxygen training, and red light therapy, and it's been just like astounding, the results with some of that, right? And who would have thought, 10 years ago, right? You wouldn't have had all these things. So I agree that just having kind of a focus towards your health, because if the health is really the foundation for everything that you have, regardless of what your net worth is.
Yeah, for sure. If anyone wants to check out Inside Tracker. That's what I use to measure like my, I'll have a nurse come to your house and they'll measure your blood and like 30 to 50 different biomarkers. And I found that to be pretty helpful. Also, Dave Asprey has a program called Fast This Way, and it's a video book combination training program on intermittent fasting, which is really practical to do. And if you follow his hacks for intermittent fasting, it makes it way more practical to pull off. And then there's a book called Why We Sleep, which is an amazing book. And if you have not read it, out of all the books I've read about sleep, that one was the best. And I would definitely recommend checking that out on Audible if you haven't already.
Yeah, very cool. There's also a new one I heard of, Wild Health. And what they're doing there is they're taking 60 biomarkers, checking all of your biomarkers, but they're also taking all of this data. They're actually using like AI and big data to collect all of your different markers, and they're checking, all these other types of samplings and things that you can do on a regular basis. And then they're putting it all together to make decisions on like, how did something, like, hey, my A1C changed over here, but was that impacted because of something upstream, or how is that going to impact something downstream? So it's really amazing. I'd encourage people to, kind of look into this more, because there's, so many new opportunities evolving.
Yeah, for sure. We've also found ways to incorporate health with doing fun things. So like we took one of our investors down in the Grand Canyon for a couple of days recently. We're going to Everest Base Camp in April with one of our investors. And we're going to Belize later this year to meet with one of our investors. And so whether it's going backpacking or on a tour somewhere, et cetera, if you can combine some of those fun adventure trips, at least for myself, with an investor you could build a relationship with, then it's kind of, a good way to really get to know someone well.
Yeah. Awesome. So I would love to talk all day about health, but let's jump into, the family office space a little bit, Richard, right? Because I think a lot of people still don't truly understand, what a family office is. And I know, you encountered that as well. So, let's just provide a little bit of context in terms of, what is a family office? Who is it for? What is the value of it?
Yeah, sure. So a family office is a balance sheet management solution for families that are very wealthy. If you're worth $100,000 and you make a mistake and you file your taxes wrong or forget to file a quarterly payment or miss a deadline, you may be penalized and have to pay a $100 fee, $500 fee. If you're worth $10 million, a mistake might cost you $100,000 or $10,000 or $5,000. And if you're worth $100 million, one mistake might cost you $1 million or several $100,000. And so the point is that not only are mistakes more expensive, they're much more likely to happen. I have over 25 different LLCs. Some of my clients have 150 plus LLCs, and missing a filing or not getting the K1 in or out on time or selling a transaction too early, too late could result in something so expensive that you basically need a full-time team to help you with managing what your capital is going into, how your capital is coming back to you. Is the capital coming back to you like it should be? What's the collateral behind a deal? Investment admin work, tax prep work, proactive tax planning work, and designing a unique strategy. Because when you go beyond having just a wealth advisor and maybe one or two rental properties, then people start making investments into operating businesses. And they start making investments as a passive LP into a GP fund or a direct investment into a real estate transaction. At that level, things start getting more and more complex. And so at that level, you need some type of virtual family office or family office solution, typically, because you're more likely to make mistakes, and each mistake could cost you what would have cost to have a full-time employee to like play defense for you, manage everything, and maybe take some of those annoying things off your plate, regulatory paperwork or whatever, that they could just kind of streamline for you a bit.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com. Yeah, makes sense. And let's talk a little bit about portfolio allocation, right? Because I think everyone is trying to, learn from the habits of the Rockefellers, right, to the ultra wealthy and things like that. So are there any trends or traits that, you typically see with your ultra wealthy clients?
Yeah, most importantly is that any solution you put in place for yourself should be based on your goals, objectives, and values, and not like a template. But if we do want to go over like broad strokes, it's really the three compartments of where they put their capital is probably most important to talk about rather than an exact percentage. So the first compartment would be your public market investments. That's where you're playing pretty much pure defense. You're just trying not to lose that capital. You diversify to an extreme. You may tell your wealth advisor that you like Costco and Tesla and Amazon, but otherwise they're diversifying you in a whole bunch of different areas, right? You don't have a ton of insight or involvement, and they just do it for you. And it's almost pure defense. Then their second area would be real estate. Most families do 80% plus cash flowing real estate, maybe some development. They might have a little bit higher risk. In this area, you typically do not want to trust your whole real estate allocation with one brain. In the wealth management area, it might be 1 to 3 wealth advisors, usually just one that you really like. In real estate, you might want to find your favorite 2 people in each real estate food group, or maybe you really like one person for some food group and you diversify into 2 each within a couple other real estate food groups. But in that area, you are choosing typically the geography, the geographical area, the food group of the real estate, meaning like self-storage, industrial, multifamily, short-term rentals, et cetera. And then you sometimes are choosing that the manager, but also the geography and their strategy in that food group. And so you're a little bit more involved, and you're not usually walking the property and inspecting the roof or the foundation, but you are saying, hey, I think that Florida and Arizona and Texas are going to grow, and I really like storage, or I really like multifamily, et cetera. So you're a little bit more involved at the strategy level, just not at the ground level. Usually the only times you get involved at the ground level is if you choose one niche of real estate and say, hey, I don't know a lot about this. I made my money in manufacturing or high tech, whatever it is. But in this one area, if it's right in my backyard, I want to build muscle internally, So let me buy a fourplex or a 10plex. Or let me get a very small storage facility and see if this is a huge pain or if I actually enjoy it. Sometimes families do that, not super often, but sometimes. Otherwise, even if they do that, they invest passively into other real estate groups. And that's a big portion of their wealth. Typically, the second compartment is real estate, mostly cash flowing. And then the third compartment would really be their direct investments. Unless they made their money in real estate, they have spent 20, 30,000 hours in manufacturing or tech or stem cells or whatever it might be. And so they have an advantage in that area. They know how to get distribution. They have credibility. They have relationships with banks, maybe lines of credit. They can open doors. People will take meetings with them almost instantly. And so they can navigate the industry very quickly, and they can be high conviction on due diligence, valuation. They can help a company play offense and hire a great CEO. They know how to recognize talent in their niche, but they can also play defense and help shore things up and fix it if things start to go sideways. So the big mistake families make typically is investing in operating businesses all over the place, and it's diversification. If you want diversification, go to your wealth advisor. If you want diversification further, you can go into real estate and choose different food groups and different brain trusts, et cetera. You do not diversify with direct investments very much typically. You typically want to only invest into profitable operating businesses already making a lot of money with great teams. If you can find those, invest directly into some of those perhaps, and then only in the space where you made your money typically. So if you made your money as a dentist, maybe invest in dental practices, et cetera. And then that way you can play offense and defense on their board or on their cap table or as the majority owner. So that's what we guide families through, which is like a really long answer to your question, but it's like a different brain should probably be managing your wealth than is overseeing your real estate allocations versus designing your direct investment strategy and carrying that out. Usually the same brain is not skilled at doing those things. And that's why the family office space is so fragmented. And I still learn more every month doing this. And I've been doing this for 16 years because it is so fragmented and it needs to be applied to the niche position of that family.
Yeah, it makes perfect sense. And what would you say if you could describe 3 top attributes of ultra high net worth clients? What would they be?
Usually work ethic, probably 49 out of 50 ultra wealthy clients I have a real strong work ethic, and they're usually passionate, high energy, engaged, almost always fast moving, and sometimes really good salespeople all in one. So that's one thing I think would be one attribute. The other one is strategic. You don't get to be ultra wealthy typically without being pretty good at either the corporate strategy of your business that you grew or just very strategically creative on how you navigate deals. So they're usually along the way of becoming worth 30, 50 million, 100 million plus have usually gotten pretty good at structuring deals. And if they've had their family office in place a long time, that's usually a skill set they get very good at. The only exception is if somebody had one business and just simply grew it organically and then sold, they might be at very low level of sophistication there, but typically very strategic in how they structure deals and navigate the industry. And then the third thing is collaborative. I would say that a lot of the people who have grown to be ultra wealthy either at some point took on private equity capital or did a joint venture or had a distribution partner, or they're in import export and became worth 100 million plus by collaborating with others that could bring them either consistent clients or consistent deal flow or goods. So I'd say that's a big part of the success of a lot of our families as well.
Yeah, makes perfect sense. And what would you say in terms of wealth strategy? We talk a lot about, kind of creating this holistic wealth strategy here, but do you have a particular one yourself that you're practicing in your own family office for the Wilson family?
Yeah. So one thing is that the wealthiest families really focus on 1 to 2, maybe at most 3 niches, even if they're worth billions of dollars. Or if they're just worth, 30, 50, 100 million, the families who defend their wealth the best use those 3 compartments I talked about. But in the direct investment compartment, they're really focused on 1 to 2 areas and being really good at playing those games. And so we've been trying to emulate that ourselves and not just provide that as advice to our clients, but do it with our own balance sheet. And so we wanted to have a real estate niche area of focus. And so we run a platform called investorresidences.com, which is our short-term rental property platform. So we have equity in 84 assets now within our fund at investorresidences.com. And I have over $1 million of my own cash invested in those properties that are in the fund. And so right now I am one of the top 2 largest investors in the fund. We then also have a focus on profitable multi-location medical practices. We find that people that go to medical school for a decade and then do a residency and then start a practice, they're very committed to their craft. They're very unlikely to run away with your investor money to Venezuela and do something that's just blatantly fraudulent or just walk away from the venture. So we really like that. And then private equity groups buy medical practices that are very profitable and have 8, 10, 12 locations for 9, 10, 12 times EBITDA. And so we like the fact that you're dealing with typically pretty committed, steady people, and they can get very high multiples, gives us kind of a sleep at night comfort while still having a high upside potentially. And so that's called medical clinic capital. And we have equity in now 24 practices, doing about 45 million a year in revenue on that side. And so with both, though, to answer your question in a way that's most helpful to other people besides the simple answer of focus, is that if you can be seen in your niche as somebody who, because of the expertise and strategic value of working with you, that somebody else would want to show you their investment deal flow first, exclusively, or at a better valuation, then you're going to compound your wealth very quickly. So we have over 2 million followers on social media, and 400,000 of those are in the doctor and dentist space. So we're one of the top 10 largest social media groups or platforms in the doctor space. And because of that, we see a lot of medical practice deal flow. And when you see a lot, you sometimes get to see deals first and then lock up the deal or say, okay, we'll take all the deal. Don't raise capital from anyone else. And we make it exclusive to us. And then many times we can add value to the transaction and make it so that we're getting a valuation that others would not be able to get, because they know that if we bring in one of my clients who sold their 40 medical practices to a private equity group, or my billionaire client that owns 37 practices, that is going to change the trajectory of their company. And it's not just money, right? It's like money plus he's actually done what we're looking to do. If you have 4 locations and this guy's sold his 40 to private equity and he's bringing the same money that someone else would have brought, this guy's going to get better terms because he can really help make that happen like 2 years earlier, or help you get to 40 instead of getting to 10, right? So that's really important. If an investor is listening here and you just take away one thing from this whole conversation, besides the ultra healthy part, it would be to see deals first exclusively and at a better valuation, and that'll compound your wealth very quickly.
Yeah, it's a real multiplier, huh?
Yeah, for sure.
Yeah, interesting. So, Richard, I bet investors are also what's weighing heavily on them, right? This is early March at the time of this recording. So much going on in the world, geopolitically, you name it, energy crisis, verge of a recession, potentially, however you want to calculate it, right? Yeah. And a lot of people, and again, I think a lot of this might stem from Wall Street, right? Which is everything is driven off of quarterly numbers. There's so much movement, right? And frankly, this is how a lot of people lose at investing, is because of that emotional factor. When they're not timing the market right. So right. What are you seeing in terms of, your client base and the ultra high net worth, and how are they kind of protecting themselves with, all of this variability and uncertainty that's going on in the market?
Yeah, great question. So I think that a lot of our clients are using less debt right now. Some clients are in trouble if they didn't have interest rate insurance, or they invest into deals where there's a bridge loan and a floating rate. So that's caused some pain, but also some opportunities for clients to take over assets just by bridging the capital that's needed, or gaining more equity than they should be able to gain, because otherwise the investors get wiped out. The other thing is they're looking for strategies that work regardless of the cycle. There's so much value being appreciated that it makes it a good deal to do, whether everyone else is a bit scared right now or not. So in our short-term rental platform, what we're doing is buying properties all cash, sometimes with seller financing, at about a 22% discount off the list price. and then we double their sleeping capacity so that we can get more revenue. So we're basically buying low, all cash, and then trying to sell high by doubling the sleeping capacity. In the medical practice world, it's capitalizing an undercapitalized medical practice platform and trying to stack up 10, 12 clinics and then go into private equity. One other example is we have some guys that we backed last year. They find really ugly motels that are just dumps and eyesores, and they fix them up into studio multifamily apartments. And that's all they do. They're laser focused only on that. And that arbitrages an asset nobody wants to an asset that everybody wants, which is workforce housing. So there's just 3 examples of moving things forward, regardless of where the cycle is. But I've been reading a lot of books from billionaires, and I wanted to show you the cover of one book so your audience could potentially look it up. It's called The Most Important Thing by Howard Marks. He's the founder, he's a billionaire founder of Oak Tree Capital, a multi-billion-dollar in AUM hedge fund. And the book is really great. And he talks so much about how when others see risk, like right now in the market, capital flows have slowed way down and investors are sitting on their hands. And he says, when others see risk and they stop taking action, there's actually less risk. Because others see risk and stop doing things, you can buy things at a discount. Now is the time where you should be putting money out. You should have been sitting on your hands when everyone was having a party at low interest rates for the last year and a half. 2 years before about 12, 14 months ago. That's when you should have been afraid, is when everyone else is excited. You shouldn't be afraid when others are afraid. And so he says that as things get really toxic and everyone thinks you're a complete idiot to put money in because this thing's going down, 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 that's when he gets the best deals of his life, he says. And so that's not easy to do. You have to have some courage to do that. But those 2 answers are kind of combined with each other, right? It's not like you just want to invest in any random deal when the market is shaky and everyone is afraid. You want to find the best of the best deals. And you want to find those deals that you got to see first exclusively at a better valuation, but also take action when other people are not taking action, and you'll be rewarded with better valuations on things.
Great insight. It's so counterintuitive to do that, right? It takes so much courage to go against the grain. And that's what I find really fascinating about this space as well. In private equity and the alternative wealth space is that, so many people just feel that they're going against the grain, right? Because of, the way they learn things originally from their peers, their employers, their parents, things like that. So I think that courage is a really brave step, but appreciate that insight.
Yeah. It's interesting that when you say like, oh, well, when there's blood on the streets, you should invest. And it's like one of those statements that like you've heard so many times. It's kind of like saying, oh, your company should have core values. Like, you just kind of tune it out instantly. But to actually act on it is the hard part, right? Like it's easy to like, oh yeah, I've heard that. But everyone knows you should just eat clean protein and vegetables and nothing else and move your body around an hour a day. And nobody does that either, right? So it's harder to actually do it.
Right. No, and that's how I've found also just having a strategy in place really helps guide you, right, during these, peaks and troughs of different cycles and things where you might have that uncertainty because you've already, at a level-headed time and place, you've been able to kind of create your boundaries, create your buy box, for these things that you're looking for. Then you can stay within it and it becomes a little bit easier.
Right. Yeah, for sure. Hopefully, as an investor or the people you trust your capital with, there's a process where the machine takes something, adds value to it, and then now it's worth more. And okay, debt's more expensive. So maybe we do more all cash and seller financing, or maybe it's a different level of debt. Maybe it's 60% debt instead of 75 or 50% LTV or something. But a well-oiled machine should be able to operate at most times, maybe not all times. Maybe need to be waiting until there's an amazing deal sometimes. But I think that's something that you want to build as an investor within your own direct investment bucket, but then look for within your real estate allocations for people who have built machines that can add value to assets and platforms over time.
100%. Richard, you've accomplished so much in such a short period of time. What would be the single biggest learning you've had, if you could share with listeners in terms of, personal productivity? What's been the single, biggest biggest protocol or process or something that you could share with people about how you've been able to achieve these results?
Sure. Well, it doesn't seem super fast from my perspective. There was one famous person, I can't remember who it is, maybe Michelangelo or something, and he said, if you knew how hard I worked, it wouldn't be impressive at all. So it's been 16 years. I know I still look pretty young for family office world, but I started the business when I was in my mid-20s. So it doesn't feel overnight to me at all. But when I started it, I wrote down affirmations. I was going to do $1 million a year in revenue. In our third year in business, we did $1 million a year in revenue. The thing that's helped me the most, though, has been a one-page kind of cheat sheet for my life. And I have my monthly, my quarterly, and my annual goals there. And then anytime I read a great book, like the Howard Marks book, or we bought Billionaires.com recently, and we're interviewing 100 billionaires there, and I'll learn something that I know I need to implement. Then I'll put it at the bottom of that one pager. So I've got about 40 little statements there that I read every morning. I read them this morning. And then I start with reading my monthly, quarterly, annual goals, and then all these 40 little half-liner statements that remind me of a book or a mentor's advice, et cetera, or an insight I got myself. And so by reading that every morning, then I go out into my email inbox or on an interview like this, and top of mind are my top clients and my top goals and our platforms we're building and what's most important to me and our business and our family, et cetera. And by doing that, then I'm less swayed by random things that come up that are just a distraction, or what I've noticed is I'll quickly remove people from our circle that just aren't like positive energy or just not in line with where we're trying to go. And it's like, there's no time for stuff like that when you have a very clear define of where you're trying to go.
Yeah, it makes perfect sense. Totally agree with that. I think it is interesting. The more you focus on, it's kind of like Dan Sullivan's quote, right? The ears hear and the eyes see what the brain is thinking.
Right.
So it's really true.
Yeah, for sure. Couldn't agree more. So it's the more that you keep those things top of mind, it's almost in your subconscious then to like be looking for those things throughout your day, right? It's like your what's it called? The reticular activating system or something like that. I forget the technical word, but you're basically saying, hey, brain, look out for all these things and don't put up with these things. And it's just kind of your operating system for the day, every day.
Absolutely. And so, Richard, if you could give just one singular piece of advice to the audience about how they could really accelerate their wealth trajectory, what would it be?
The most important one is seeing the deals first exclusively and at a better valuation. Get your position in the industry so that people just are thinking of you top of mind to show you that medical clinic deal or the short-term rental deal you have. That'd be the most powerful. The second one is that the more integrated your life is, then the faster things go, and the faster people want to help you, and those that are aligned with you will want to work with you that much faster. So aligning, like if I know it's important to be ultra healthy, then aligning things in my life to be more healthy, but also having the right people on my team, living in the right location, everything from the food you eat to the books you read, and how you spend your time and the media you consume, all of that. If it's integrated well, then you're constantly growing and learning and enjoying yourself. If there's a lot of friction, then you're just dragging all these anchors behind you, and others can't even really see where you're going or if you're going to make it there. So the more integration and integrity you have across your whole life, then I think the faster things go, including with your investments, right? If you have certain goals and objectives for your family office that have never been written down and no one's even asked you what those are, and your family and advisors don't know what they are, and then someone shows you a deal and you don't know your family's values or your own goals, how are you going to evaluate whether you should do that deal or not? It's just, you might do the wrong deal, and maybe you shouldn't be doing any deals until you figure that out.
Yeah, great insight. So Richard, if people would like to learn more about family offices, what you're doing at family office residences, what's the best place to reach out, connect with you, to learn more? Sure.
Yeah. Well, our community runs 15 live events a year. I'd be happy to have you come check out one of those on us, Dave, so you can come and see it in person here again soon. But it's called Family Office Club. And if you are raising capital, have a fund, or syndicating deals, you can go to familyoffices.com and see our next live event coming up. Quarterly, we do a big investor summit, and then we have a dozen workshops a year typically. We've got a free book on family offices at familyoffices.com. We have a free book at capitalraising.com if you are looking to raise capital from the ultra wealthy. If you are an investor and you want to connect on investorresidences.com or Medical Clinic Capital, the fastest way to do so is just go to investorclub.com, and there's a little 30-second form, and then Laura Clay or I will pick up the phone and connect with you over email or phone and see how we could work together. So I think that those would be the most clear ways. And hopefully I'll be meeting some of your listeners in person at one of our events, or come up and say hi if you see me speaking at an event you're at, and we can connect that way as well.
For sure. Really appreciate your time today, Richard. Just really grateful for the opportunity for you to be able to share the wisdom and insights. I mean, so many great nuggets. I know people are really going to enjoy this episode, and hopefully start to, create a relationship, of learning, right? Because we're all on this journey together. So thank you again for your time. Really appreciate it.
Yeah, appreciate it, Dave. Thanks for having me here.